Good morning, this is Bloomberg Daybreak Europe. Happy Wednesday. I'm Tom McKenzie in London. These are the stories that set your agenda. Stocks gain as the Fed chair signals another rate cut is coming later this month. Investors then shrugging off renewed trade tensions between the US and China. Wall Street banks report bumper earnings, while luxury giant LVMH surprises with a return to growth. We will break numbers shortly from ASML, Europe's most valuable company. Plus, the French Prime Minister is expected to survive no confidence votes today after dropping plans to raise the pension age. So let's get straight to the earnings story then. ASML, of course, the most valuable publicly listed company in Europe, coming through with third quarter net sales of 7.52 billion euros. 7.5 billion euros in net sales, slightly softer than the estimates. So missing the estimates, there had been a view of 7.71 billion. ASML coming through with 7.5 billion euros in the quarter on sales. ASML seeing fourth quarter net sales. So this is projecting out to the fourth quarter. Net sales seen coming in at 9.2 billion euros to 9.8 billion euros at the top end of the range. The estimates had been for 9.2 billion. So at the top end, in terms of the fourth quarter, that's a beat coming through from ASML. So the stock up about 25% year to date, as you can see behind me. We'll get all the details around ASML. The implications, of course, as investors had started to thought about whether or not the investments into Intel and Samsung would benefit ASML. That is a story we continue to monitor for you, of course. So the fourth quarter view is stronger, but in the most recent quarter, slightly softer on sales. Let's get to the broader market picture then as we think about the earnings story. Banks in the US, of course, coming through with strong beats. JP Morgan, Citi, Goldman Sachs. Today, it's about Morgan Stanley and a number of others, and we'll preview those for you. European futures then pointing higher by 1.1%, so set for a very strong session. Risk on across the global equity picture right now, and this is largely down to expectations that you will get a cut from the Federal Reserve at the end of this month. Jay Powell pointing to his concerns about the labour market. FTSE 100 futures pointing higher by 41 points. S&P E-minis stateside looking to add 23 points. NASDAQ 100 futures looking to add 0.4%. Again, these markets looking through the tensions that continue between the US and China. Let's flip the board and have a look cross-asset then. There were the positive developments in France as well. So we'll look at the French sovereign debt when that starts trading later. You saw a rally in French OATs, the 10-year yield falling yesterday, the biggest rally that we've seen in about 3 months on adjustments in terms of the politics of France and the Prime Minister getting the backing of the Socialists. Crucial, of course, in terms of the prospects of a budget being passed. The 10-year stateside currently at around 4%. Yields moving just 2 basis points. Euro-dollar at 116. Currently slightly stronger versus the US dollar. We're seeing the Bloomberg dollar index down. Euro is gaining up 0.1%. Gold still near those fresh record highs, of course, for the yellow metal. Gaining again in the session. Look at that. Gold up 0.9%. The gains keep coming for gold. Brent at $62 a barrel, currently a little softer on oil by 0.3%. It's been a strong session in Asia. Let's cross over right now to Winnie Su, who's standing by for us in Hong Kong. Winnie.
Yeah, so like you said, Tom, Asian stocks have been extending throughout the trading hours, and we are seeing that the gauge is up some 1.7% right now. So it's pretty much reversing all losses from yesterday already on that global story that you mentioned of the optimism around the Federal Reserve to cut rates. Now, also Hong Kong stocks are also reversing these losses from yesterday as investors now are more hopeful that the U.S.-China tensions will eventually ease. Onshore stocks a little bit more muted even after we saw that set of data showing that deflation pressure is easing, but price declines still continue. Now, if we stick with China, something interesting today that we would like to highlight is that we are seeing the PBOC's stronger than expected fixing, and that is sending the offshore yuan stronger, and also the strength also continues through all these other Asian currencies, amid this backdrop of the weaker U.S. dollar. So this is interesting because it is the first time since November last year that the PBOC is setting this fixing level at a stronger level across that 7.1 level against the U.S. dollar. So some say that it is a strong message that China has that negotiation power against the U.S. Now take a look at what's going on in Japan. It's also a pretty resilient picture there with stocks rising, and we also saw a relatively strong demand when it comes to the 20-year JGB bond auction. So this is coming amid this political instability, and all eyes right now are on that upcoming meeting later today among the leaders of the major opposition parties of Japan for them to discuss who might be that next candidate to rival Takaichi.
Winnie-Sue, thank you very much indeed. Joining us out of Hong Kong, of course, the uncertainty, as Winnie was saying, around the politics of Japan as well, and whether Takaichi will be the next Prime Minister of the country, and what it all means, of course, for the fiscal spend that could be coming through from the next government of Japan. Meanwhile, fresh trade tensions have emerged between the US and China as President Trump says he may stop trade in cooking oil with Beijing. The US president cast the potential move as a retaliation against Beijing for its refusal to buy American soybeans, which he says is a, quote, economically hostile act. Joining me now is Bloomberg's China economy and government editor, Alan Wong. Alan, how much of an escalation then is this from Trump? Put this in context for us.
Yeah, Tom, on the surface, this is certainly an escalation, but the nature of it may be rhetorical or maybe in substance, we don't fully know. But certainly this adds tension to the U.S.-China relationship. But I think critically it fits a familiar pattern of Trump's whiplash that, above all, has kept investors anxious and, honestly, the trajectory of U.S.-China ties unclear. Just an example of this whiplash, just hours before Trump made this threat on Truth Social, both the president and his top trade negotiator, Jameson Greer, were just expressing some cautious optimism about the coming talks they're going to have with China. So this particular move on cooking oil is framed as an act of retaliation. First, for China's refusal to buy American soybeans, which obviously hits U.S. farmers hard, and they are one key constituency for Trump. Second, it just came after Beijing recently expanded its rare earth curbs, which the U.S. Treasury Secretary said amounts to pointing a bazooka at the global supply chain for these really critical minerals.
Yeah, and it seems like we are in a period of brinkmanship between the two sides. What will the likely response be from China? And to what extent can we be confident that this meeting between President Xi and President Trump will actually happen?
Yeah, but I think it's important to note that both sides, even as they warn against further unilateral actions, they would say that the door to talks remains open. So based on their recent actions and the pattern of China's behavior in the current trade war and the previous one, China's response will likely be firm. But this particular threat probably won't be the thing that scuttles the meeting, expected meeting between Trump and Xi later this month. Both sides are still preparing for talks. We know that there was a working level meeting earlier this week between the two countries. And Beijing also tends to only make a move after any U.S. measure comes into effect, not when it's threatened. So the other thing to watch out for is how just besides cooking oil and rare earths, there are also other measures and tit-for-tat exchange of steps between the two countries, including the Beijing sanctions of the U.S. units of a South Korean shipping company for cooperating with the U.S. probe into China's maritime industry. So there are many conflicts on different fronts, but do they amount to a big challenge to getting the two sides to the negotiating table? That's one thing that we haven't been able to find out, and we might only find out when the time comes for them to meet.
Okay, Bloomberg's Alan Wan, thank you very much indeed for that update as we continue to watch, of course, the adjustments and the reactions between both sides, the US and China, ahead of that potential meeting. Alan, thank you. Meanwhile, the Fed chair, Jerome Powell, has signalled that another rate cut is on the cards later this month, citing continued weakness in the labour market. In a speech at the National Association for Business Economics annual meeting, Powell referred several times to the low pace of hiring.
The labour market has demonstrated pretty significant downside risks as payroll jobs have declined, and both the supply and demand for labor has declined quite sharply. So, those two states of affairs for our two goal variables, call for different monetary policy responses. So, as they come more into balance, I think the idea has been that policy should move from being tight to some degree to being more neutral as those two things balance out.
Okay, let's bring in Bloomberg's Valerie Teitel then for the market reaction to this. Val, help explain then the upside that's coming through for the equity story. This is a Fed chair who's essentially confirming the market pricing for October. Was it the labour market comments that are leading to the upside for equities? Explain why we're seeing such a strong response in the stock moves to these comments.
Look, Tom, I think it was just the absence of any curveballs from Jerome Powell yesterday that led to this positivity in the equity market. There really wasn't a lot to change his mind versus the previous meeting back in September. So in some way, he just verified the dot plot, which does show two more cuts for the remainder of the year, one in October and one in December. But it was really this key quote at the beginning of his speech, which kind of signaled that he was headed in that direction, basically saying that the outlook for unemployment and for inflation has not changed since the September meeting. That was the signal that the market needed in order to verify that, yes, that October rate cut is on the cards when they meet in a few weeks' time. He did say some interesting things about the labor market. He did seem to harp more on the labor market weakness than on risk to inflation. That also helped the equity market out a bit, as it just entails more cuts are coming ahead. He did cite the low pace of hiring several times, also warned of the risk of the rising unemployment rate. And he did dismiss the fact that the immigration policy, the tighter immigration policy, is leading to wage inflation. He said they're not seeing that yet. They're seeing a drop in labor supply and labor demand. The risk is that labor demand is dropping more than supply. He was asked, what kind of data points are you watching now that we don't have this federal data? And he did say the state level jobless claims are a good indicator. If you take a look at what's behind me, Bloomberg Economics has put together the state level jobless claims in order to reflect a national figure, and those have showed a steady creep higher over the last few weeks. So this is a data point to keep in mind. It does come out on Thursdays, the same time as initial jobless claims. It just takes economists a bit longer to put together all 50 states for a national number. So this is a key data to watch. It will be released tomorrow, one to watch on the calendar. He did also signal the end to quantitative tightening is going to be coming in a few months. Now, that was sooner than the market expected, Tom. Another reason perhaps why risk took what Powell said quite decently. The balance sheet runoff, they want to end in the coming months. Now, this was maybe a bit of surprise when you looked at how swap spreads traded. This is a bit of a nuanced factor here, but essentially we saw a stronger bid into treasuries than we did into interest rate derivatives as he spoke. It was one of the biggest moves for swap spreads year to date.
Okay, pulling forward the end of quantitative tightening. Breaking down for us the comments from Fed Chair Jay Powell and the market moves on the back of those. Bloomberg's Valerie Teitel, thank you very much indeed. Let's get back to the earnings story right now. ASML earnings, of course, broke at the top of the hour, and third quarter orders beat expectations for ASML. For the context, let's bring in Bloomberg intelligence analyst Masahiro Wakasugi in Tokyo. Masahiro, what are your takeaways then from the earnings and the numbers that have come through from ASML?
Yes, according to ASML, its revenue in the Q3 were around 7.6, around 6.7 billion euro, and that was a little bit below the midpoint of the guidance. But it was not really a surprise. And if we look at the order bookings, it was about 5.4 billion euro, and above the consensus. But it's quite similar to the net system revenue of 5.5 billion euro in the third quarter. So I think that the order bookings for the net system is balancing, between the orders and the revenue. So if we look at the order bookings, so it's pretty similar to previous 33 billion euro at the end of Q2. So maybe Q2, Q3 order backlog should be almost the same. So I mean that in that sense, pretty much okay. And if we look at the guidance, revenue guidance, it's quite no surprise. And if we calculate the total revenue for this year, it would be 2-point-something billion euro for this year, which is in line with the expectation. So I see pretty much in line result and guidance.
Okay, in line when it comes to the guidance. What does that tell us about the outlook then?
Okay, so as we speak, as we spoke about the orders backlog, and that's around 33 billion euro at the end of Q3, and this year's revenue would be 32-point-something, and the consensus for next year is around 4% revenue growth. So maybe that would be around 33 billion euro for next year's revenue consensus. So in that sense, probably ASML's backlog should be good enough to cover next year's revenue. Maybe Q4 order bookings could be quite good, and maybe Q1 is okay. So in that sense, ASML could increase the revenue, and also ASML management says that 2026 revenue will not be below 2025 level. So that should be the good sign. And people know that Intel will cut capex next year because of the current situation, and also TSMC is quite a large spender, and they will not be very aggressive in the beginning of the year. So we will not see very strong capex news in the near term. So in that sense, maybe ASML's pretty decent expectation for 2026 is not very much surprise for us.
Okay, Bloomberg intelligence analyst Masahiro Wakasugi, thank you very much indeed, breaking down the numbers that we've got from ASML. That is a stock to watch at the open this morning, of course. Coming up, meanwhile, JP Morgan reporting bumper earnings, but CEO Jamie Dimon warns of cockroaches in the credit market. Details are next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Wall Street's biggest banks have reported record growth, but JP Morgan's CEO set a cautious tone, warning of risks in the credit market. Jamie Dimon's comments follow the collapse of auto lender Tricolor, which resulted in a $170 million hit for the bank.
You should assume that whenever something happens, we scour all process, all procedures, all underwriting, all everything. And, we think we're okay and other stuff, but my antenna goes up when things like that happen. And I probably shouldn't say this, but when you see one cockroach, there are probably more. And so everyone should be forewarned on this one.
Everyone should be forewarned this morning. Bloomberg's Charlie Wells is here to discuss. Charlie, put these comments by Jamie Dimon in context then.
Well, Tom, they're certainly colorful, and they really reflect the question that a lot of analysts had, which is, how bad are things in credit markets? And this was effectively Jamie Dimon owning that point that there could be trouble lurking out there. And this reflected some of the other commentary that we got from bank executives over the course of the day on these earnings calls. We had Mark Mason, the Citigroup CFO, talking about how consumers are being a little bit more discerning in their spending. And you had David Solomon from Goldman Sachs talking about some of the divergence that we might see despite the optimism in technology in AI right now. Some of these more cautious comments weighing on even stellar performance that we saw. If we look at, say, investment banking fee growth from Goldman Sachs, a 42% jump for the quarter. This was incredibly solid on the back of this deal bonanza that we've been seeing. Solid reports from the other banks as well. But when you look at share price performance, how these banks performed, how this was received by the market, you got a mixed picture. So you saw a slip with Goldman Sachs. You saw a slip in the performance of JP Morgan, perhaps perhaps reflecting some of the optimism that we'd seen, maybe too much optimism, and then a jump for some of these other banks, but certainly a mixed picture here.
Okay, a bit of a mixed picture, a beat across the board, but warnings about, from some at least, the credit markets and some tensions within the broader economy. What are we expecting then? How does that position us for how we should be thinking about the earnings that drop today? Morgan Stanley is one of the names, isn't it, Charlie?
Morgan Stanley is one of the names. We are in the eye of the storm of these earnings reports. And look, Morgan Stanley, you mentioned, it's very similar to Goldman Sachs. They are arch rivals. Interestingly, we saw with Goldman a miss on equities trading revenue. So a little bit too much optimism there. That could play out in some of these reports later today. We've got a Bank of America reporting as well. Net interest income in focus there. We're operating in a new rate environment. So that changes the dynamic. We've seen some misses on net interest income, but some forecasting as well that Bank of America could stay on track there. And when you think about the competition that we're seeing, the shape of these banks, we look at Morgan Stanley could come out looking a little bit like Goldman Sachs, and then we've got Bank of America similar in line to sort of a Citigroup or a JP Morgan. So we will be on the lookout for that as these earnings drop in just a few hours.
Okay, Charlie Wells, thank you very much indeed for the setup for the further bank earnings crossing later today. Charlie with the details. Coming up, to luxury and LVMH reporting a surprising return to growth. So, could this signal a comeback for luxury? More on that next. This is Bloomberg. LVMH has unexpectedly returned to growth in the third quarter. For more, let's bring in Bloomberg's Angelina Khaskuit joining us from Paris with the details. Angelina, what then has fueled the growth at LVMH this quarter? Is it likely to be sustained?
Hi there, Tom. Indeed, what was interesting is that all the divisions beat, including the key fashion and leather goods one. I mean, that one was still negative, but what was interesting, as explained by the CFO of LVMH, was that it was driven by, it's improving thanks to more traffic and volume, so not a price effect. Importantly, the struggling wines and spirits division, which had been, in a downturn for 2.5 years, is growing again, helped by champagne restocking in the US, solid rosé wine demand, even though cognac is still suffering. Geographically, Europe is down. It's the only region that worsened. That's because there's a lower tourism spend with the weak dollar against a stronger euro. However, China returned. The region that includes China returned to growth. What we're seeing is that people in mainland China are growing again. Offshore, Hong Kong, Macau, it's still down, but it's improving. So overall, positive news. When it comes to creative renewals, we had quite a few changes in designers. We will see the impact of that in the first half of next year. That's what the CFO said. So overall, pretty good.
Yeah, and as you say, the turnaround in China, if that's sustained, could be really significant and potentially significant for the broader luxury sector as well. What are the signals for the broader sector from these LVMH numbers?
I mean, absolutely. What we saw yesterday is that competitors, Zegna in the US was rising. Today, right now in Hong Kong, Prada is gaining. So it's probably going to lift the whole market this morning in Europe. Next week, we're going to have more results. Kering is in turnaround. They have a new CEO. They have a new CEO at Gucci as well, a new designer. We're going to get results from Hermes, and Richemont will be in November. So. But it's encouraging, for sure. It's encouraging, and I think that's what the market is telling us. Mm-hmm.
Okay. Bloomberg's Angelina Khaskuit, thank you very much indeed, breaking down the LVMH numbers for us and the implications, the read across to the broader luxury space. Thank you. Coming up, we're going to speak to Elizabeth Ingleson from the London School of Economics about rising trade tensions between China and the US. That analysis is coming up. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda. Stocks gain as the Fed chair signals another rate cut is coming later this month. Investors shrugging off renewed trade tensions between the US and China. Europe's most valuable company, ASML, reports third quarter orders ahead of estimates as AI investment fuels demand for its chip-making machines. Plus, the French Prime Minister is expected to survive no confidence votes today after dropping plans to raise the pension age. Let's get to the markets then, and certainly it was the comments from Fed Chair Jay Powell essentially locking in another rate cut at the end of this month, plus a strong earnings story coming through from US banks, and that's being reconfirmed by the likes of LVMH towards the end of the day yesterday. The market print then on luxury will be in focus when stocks open. That is tying into it, as is the beat from ASML. So we look at tech as well more broadly in Europe. European futures pointing to a very solid session after a bit of dampness yesterday, down 0.4% by the close yesterday. Today looking to rip higher by 1.3%. Here in the UK, FTSE 100 futures pointing higher by 41 points. S&P E-minis after a modest drop yesterday. US futures pointing higher by 0.4, and the picture is similar for the Nasdaq 100, looking to add 0.5%. Let's flip the board and have a look cross asset. We of course focus on treasuries given the comments from Fed Chair Jay Powell. His concerns about the labour market. So the 10-year is bid this morning. Yields are down 2 basis points, 4%, just over 4% on the benchmark. The euro is at 116, a little stronger on a softer dollar, currently up 0.1%. The single currency. Gold closing in on 4,200, still at record levels for the yellow metal, adding another 1% in the session today. And Brent is down 0.3%, with a focus, of course, on those US-China trade tensions. $62 a barrel right now on Brent. Let's get more on what we're expecting then on the markets with Bloomberg Markets correspondent Nora Melinda. With all those factors playing in, Nora, what are you looking at? It's earnings, it's Fed Chair Jay Powell, it's those US-China tensions. There's a lot really for markets to navigate.
Well, the market just cannot get enough. There's a lot to keep an eye on right now. But I want to look at tech. That's something that you called out here, Tom. We've really been seeing a lot of these names really buoyed this year. We've seen them as some of the biggest gainers in the market in the past couple years. But there really are some conversations right now, speculation percolating here, that there could potentially be an AI bubble. We're seeing a lot of market leaders starting to come out expressing the idea about whether or not we're actually seeing the investments, all the money being poured into some of these large AI efforts actually paying off. Of course, we have yet to see that in earnings, so they'll be really parsing to see the likes of Nvidia, AMD, Oracle, CoreWeave, of course, a recent IPO here, to see whether or not all the money that's being funneled into some of these data centers and the big AI names is actually paying forward here. But let's take a look at what's happening in the market. Let's take a look at S&P 500 futures. Of course, it's been quite the week here. A lot of trade tensions in focus between the U.S. and China. S&P 500 futures up today, of course, after ending lower yesterday in a very volatile session here. Looking at spot gold here, up a little bit, a touch this morning as we kind of look at people looking for a safe trade right now, a safe haven space to be, especially in a market full of uncertainty, and also looking at the U.S. dollar here. Of course, we've got the index pushing a bit lower. We know that this has really been a pressured currency here as we look at the greenback and its performance so far this year, Tom.
Okay, Bloomberg Markets correspondent Nora Melinda, thank you very much indeed for that update. Let's return then to a topic that Nora touched on, which is US-China trade tensions and that volatility. One of our top stories, of course, President Trump ratcheting up tensions with China by considering a termination of trade in cooking oil. For more on this, I'm joined now by Elizabeth Ingleson, Associate Professor of International History at the London School of Economics with deep expertise on this area. Elizabeth, good morning. Thanks for joining us in the studio. What is the game plan for China then? It really set off a ripple effect globally when they came through with these restrictions on rare earth minerals, and particularly the extraterritorial nature of those restrictions. What is the game plan for China? Is this posturing, or is there something more fundamental that Beijing is now deploying?
Yeah, this is a really important question, Tom, because on the one hand, there's absolutely an element of wanting to show its bite in terms of the US-China trade tensions and the US-China trade dynamic. But really underpinning what came out from the Ministry of Commerce last week is something much more, as you're getting at, fundamental. So if we look at some of the details, on the one hand, there were additional rare earths that were added to China's export export control list. So in some ways, that's just continuing what has been happening since April. But there were also, as you're saying, extensions of this. And part of that is extraterritorial jurisdiction over technological goods that are made using Chinese products. And that is actually, in many ways, based upon US export controls and a sort of an adopting of US export toolkit that has been in place since the 1950s. And so what China is doing is, on the one hand, extending the sort of the pinch on rare earths, but with extrajudicial controls, as well as, I think, something that has been a bit more under the radar, but also controls on lithium batteries. China is also seeking to put in place much more long-term structural controls on how very crucial supply chain dynamics operate. So with the extrajudicial limits on tech, for example, but also the lithium batteries, that is an attempt to put a real chokehold on supply chain spaces, and that is a long-term vision that China hasn't just thrown out into the ether out of a sort of attempt to sort of show its hand in US-China trade. It's a much more considered and long-term policy decision that has been long time coming.
Well, when we think about the response from the EU, when we think about the response, the concern in India, is this a China that potentially risks overplaying its hand?
I mean, it's a China that is certainly seeking to do, as we're saying, two things at once. And there's always a risk in the short term with the sort of escalation with tensions on US and China that it will overplay its hand, in the same way that there's a risk that Trump, in fact, in some ways a higher risk that Trump will overplay his hand too. So in that trade war tension, there's a very high risk. But I think what we're seeing with something like the controls on lithium batteries and also the sort of controls on tech coming from other parts of the world is that is it's an imposition of export controls that may or may not be used to some degree. So it's putting in place the infrastructure, the capacity for China to really put the pinch and the hurt on companies that would be affected, but not necessarily in the short term putting it into play. So it's putting a much more long-term structural
giving
change.
themselves the tools to be able to take that action if and when they feel that they need to do that. Do you expect a meeting between the two presidents to happen? And what would you be watching for? Is there a potential a grand deal that could be struck? I mean, Trump clearly wants some kind of deal with China. What will you be watching for?
I mean, this is the million-dollar question. Will they meet in APEC? I mean, this has been a question that's been going on really since the spring. I think that the idea of a grand bargain is not quite understanding how the US-China trade dynamic operates. What I think is happening at the moment is a reminder that over the spring and the summer, we've seen here in Europe a whole range of bilateral conversations, first in Geneva, then in London, here, as well as in Madrid, a real capacity for both sides to demonstrate an interest in negotiating and in trying to sort of hammer out some of the problems. But underlying every single one of those negotiations were tensions. And what we're seeing at the moment is a reminder that there was always a really soft underbelly to those conversations. And so in that sense, we are being reminded that whether or not the conversation actually does happen between Xi and Trump in person, that there are really underlying structural tensions between the US and China.
Okay. And briefly, on the question of semiconductors and chips, we know that there are some tensions within the White House, within the U.S. administration, the Trump administration. Is that muddying the waters in terms of the U.S. response? How pronounced are those differences? So
the differences are simply between hawks or maverickly hawks. So I mean, we're not. There are no real doves within the Trump administration. It's more a matter of those who are perhaps more inclined to sort of allowing for some kind of business stability and sort of promoting a sort of a confidence and a business-oriented confidence, and those who are much more interested in perhaps the geopolitics and in the punitive approaches to China. And those tensions have always been at play in the Trump administration, and we're going to see it come to the fore again and again over time. Just on the semiconductors, if I may, one additional really important point that's happening with China's chokehold on export controls now, very broad export controls on lithium batteries, is that is putting a chokehold further up the supply chain on the manufacturing of chips.
Yeah.
So it's a way of China also putting its own or showing its own capacity to hurt in the larger story of chip making, because chips don't use the lithium battery, but the process of making them does. And so it's China's way of also sort of asserting its supply chain power in that specific way.
It's not just rare earths to think about, but lithium batteries as well, and how China is leveraging that. Elizabeth, thank you very much indeed for the analysis of the context in terms of what we're seeing around the US-China tensions. Elizabeth Ingleson, Associate Professor of International History at the London School of Economics. Now to France, where Prime Minister Sébastien Lecornu has won the crucial backing of the Socialist Party in the National Assembly. The Socialists, who hold leverage in the lower house, say they won't vote to topple Lecornu's fledgling government after the PM promised to suspend President Macron's unpopular pension reform.
C'est pourquoi je proposerai au Parlement dès cette...
This fall, I will propose to Parliament to suspend the 2023 pension reform until the presidential election. No increase in the retirement age will take place from now until January 2028, as specifically requested by the CFDT union. In addition, the duration of work taken into account will also be suspended and remain at 170 quarters until January 2028.
So let's bring in Bloomberg's Caroline Cornat, who's in Paris and, of course, has been following all of this for us. Caroline, this is a turn of events that not everyone expected. A lifeline, then, for Sébastien Lecornu and his government. Does he survive these no-confidence votes? Are we getting closer to a budget finally being passed?
He will survive these no-confidence votes this week, because clearly the kingmakers in Parliament now are the Socialists. And Sébastien Lecornu knew that. Everyone in his entourage had been calling over the past few days for suspension of this pension reform, because this was clearly the red line for the Socialist Party. And you heard from the Nobel Prize winner Philippe Aghion calling to suspend the reform. You heard from even the former finance minister in Bayrouth's government, Éric Lombard, just yesterday, saying we need to suspend this reform. Of course, the Socialists claim this as a victory. You could see during the speech yesterday of Lecornu, Olivier Faure, the first secretary, and François Hollande, the former Socialist president, clapping their hands in Parliament and smiling as Lecornu was suspending Macron's flagship reform of 2023. Of course, this comes at a cost. Suspending the reform will cost 400 million euros in the budget next year, as much as 1.8 billion euros the following year. That's according to Lecornu. This will need to be compensated in the budget, but at least in the short term, we avoid another government collapse and a deeper crisis in France.
OK, and so on the question of the budget then, Caroline, what are the prospects that we finally get one? And what is in the initial... There was an initial budget proposed yesterday. What was in that one, and how much of that is likely to survive?
Of course, the Socialists do not like the initial proposal of Lecornu, which is presenting 30 billion euros of savings, 2/3 coming from spending cuts, 1/3 coming from new taxes. I'll give you a few measures proposed. Freezing pensions, freezing benefits and income tax brackets, the super tax on big companies that was imagined by Michel Barnier at the end of last year will be extended. There will be also an extension of a tax on the wealthy, but the Socialists want more. They want the so-called Zuckman tax of everyone who's got more than 100 million euros in assets. That will be a heavy debate in Parliament. The Socialists have promised they will amend this budget heavily over the next few weeks and months. So clearly the debate is not finished, but Lecornu has himself given one red line. He wants at all costs to bring the deficit back to 5% of GDP next year.
OK, an important step, but a lot more work to be done over in France. Bloomberg's Caroline Connor in Paris. Thank you for that update. Here's some other news and stories making the headlines this Wednesday morning. Bloomberg learning that Apple is preparing to make more of its products in Vietnam as part of efforts to diversify away from China. The company is also pushing into the smart home market and is working on a new range of devices, including security cameras, command hubs and robots. AMD shares rose in New York after the company landed a major chip order from Oracle. It says Oracle will put 50,000 of its newest semiconductors into data centers from the third quarter of 2026. The announcement is a sign that AMD is making progress in its race to catch Nvidia. And Stellantis says it will invest $13 billion in the US over the next 4 years. It aims to reinvigorate its business by boosting vehicle production by 50% and curb the impact of tariffs. It's the single largest investment in the company's more than 100-year history. Coming up, China stepping up its submarine game, leaving the US racing to catch up. We'll dive into today's big take. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, submarines are a vital asset for any country's navy, and for decades, the US has maintained its undersea superiority. But with production delays and a labour shortage plaguing the industrial base, it may be in danger of losing its edge. That's as China is rapidly building up its own submarine fleet, opening up a new front in their superpower rivalry. Bloomberg senior producer Ryan Chua joins us now for more on today's Big Take. It's a fantastic read, well worth your time on the terminal and on Bloomberg.com. Ryan, who's behind the Big Take, joining us now then. Severe problems then, Ryan, really kind of facing the US submarine industrial base today. How significant are these issues?
Well, that's right, Tom. The problem's quite severe, and U.S. officials are becoming increasingly concerned. So we're talking here about two next-generation submarine programs that are costing billions of dollars and are both facing significant production delays. So on the one hand, you have the Columbia-class ballistic missile submarines, which will be the largest in the fleet and carries a lot of power. So the first boat, the first of 12 boats in that class, is facing delays of 12 to 17 months. And then you have the Virginia-class attack submarines, which will form the majority of the U.S. fleet. Now, the latest of those boats will be delayed by up to 3 years. So really, the worry among officials is that the U.S. won't be able to produce enough submarines, not only to replace the aging ones in the fleet, because some of them are due for decommissioning in a few years, but also to maintain the U.S.'s overall advantage when it comes to the undersea domain, Tom.
And on that point, Ryan, how close then is China to actually catching up, and how much concern is there amongst US officials about that prospect?
Well, we should know that China doesn't publish official figures when it comes to their naval capability. So what we have are independent assessments and intelligence reports. But what the figures and the data are telling us is that China is rapidly building up its submarine fleet. We cited a study in our story that found that China is building nuclear submarines at a rate of 4 to 6 per year. That is so much higher than the U.S. production rate right now. And we also found that a lot of these efforts are geared towards research and development, upgrading their shipyards. And the U.S. Defense Department's own assessment predicts that by 2035, China's fleet of submarines will grow to about 80. So there's a real concern among U.S. officials that at the rate that things are going right now for the U.S. submarine industrial base, there really is not enough time for the U.S. to maintain its undersea superiority and advantage, and China will eventually catch up. Now, that will have huge implications when it comes to the U.S. naval posture and deterrence, particularly here in the Indo-Pacific. Tom.
Ryan, what is the US doing then to kind of address some of the issues that you highlight?
Well, they're really putting money into the problem. They've been spending billions of dollars in the past few years, and they're planning to spend more. And in fact, they commissioned a shipbuilding review in the past year that really found, that really established that these programs were getting delayed and prompted, a lot of people in the U.S., a lot of politicians to pour money into the problem. So the Trump administration's signature tax and spending measure has $29 billion earmarked for the maritime industrial base as a whole. And then there are pending measures in Congress right now, both in the Senate and the House. The Defense Appropriations Bill that has billions of dollars allocated specifically for the submarine industrial base. And a lot of these efforts, a lot of the money are slated to go into supply chain issues, how to fix them, and workforce development programs.
Okay, Ryan Schwa, thank you very much indeed. Really fantastic piece of reporting. You can find that on Bloomberg.com and, of course, on the Bloomberg terminal. Ryan Schwa behind today's Bloomberg Big Take. There's a lot more coming up. We'll walk through what's been happening in terms of French sovereign debt, the critical minerals story as well, and how that's benefiting Australia, and why Jamie Dimon is now concerned about credit. That's coming up. This is Bloomberg.
We're putting a lot more emphasis on productivity growth really going forwards, and that is the thing that fell off in the post-2008 period. Certainly, in all countries other than the US. And of course, even in the US, it's very focused on the tech sector. If you look at the US, US absent the tech sector, it looks much like the rest of us in many ways.
The Bank of England Governor Andrew Bailey, of course, as the debate continues around how far and how fast the BOE can go with that uptick in unemployment and wages softening, but inflation still relatively sticky. We're watching the luxury sector, of course, over in France. Expect this to rip higher in the session today on the back of a return to growth for LVMH and some strength, really interestingly, in China as well. LVMH getting 9.2% on Tradegate versus the Paris close. Kering also gaining 7%, more than 7% on Tradegate. So watch the luxury space and what that does for the CAC current, of course, at the open at 8 a.m. UK time. Let's flip the board and have a look at what's happening in terms of the minerals space in Australia. Here's the beneficiaries then. Here are some of the beneficiaries from, of course, the trade tensions and the export controls that China is putting in place. And some of the mineral names listed in Australia have soared more than double digits on the back of this news, and expectations that maybe the Trump administration might be looking to take some equity stakes in some of these companies, particularly the Australian mining companies that have operations in the US as well. Just one of the effects of this increased tension over the rare earth story and how that's playing through to the Australian companies. Let's flip the board and have a look at the warning that's come through from Jamie Dimon, of course, of JP Morgan, in terms of the cockroaches, as he described them, that he's seeing in the credit markets, particularly private credit. And he referenced business development companies that are essentially a proxy for the $1.7 trillion private credit market. And you've seen a spread in terms of the fall-off and the drop of those BDC companies versus the broader equity space. That's something that Jamie Dimon flagged. So concerns and a spotlight on credit, particularly the blowout and the bankruptcies around a couple of auto lending and parts companies. Now, the Canadian Prime Minister, switching focus, Mark Carney, is the first guest on the Michelle Hussein Show. That's a new Bloomberg podcast. It launches on Friday. You can, of course, download that and get it from the website as well. But the opening trade is up next. Stay tuned for that one. This is Bloomberg.